Hello and welcome to Average Traders. This has been a absolutely crazy week, and Rajan, why don't you just take us through it?
I mean, where do I start? It's like this year has just, it's been a combination of just everything happening all at once. Starting off with inflation, we had CPI last week, which came in at 7.9%. Today we had the Fed raise interest rates for the first time in over 4 years. We still have the Russia-Ukraine war continuing, causing loads of havoc, and loads of companies and entities withdrawing from Russia and still having an effect on commodity prices. Last week we did see oil hit a high of 130 on WTI, and then today and is now back below 100. We've seen a lot of the commodities subside somewhat. Today, the beginning of the week and the big end of last week, we saw a massive decline in Chinese stocks, especially the Hong Kong internet shares. And today we just saw a once-in-a-lifetime monumental rally where KWEB, the Chinese internet ETF, rose almost 40% in one day. I mean, that comprises of stocks like Baidu, Tencent, Alibaba, JD.com, and never seen such a thing. 40% in one day for an index of large cap tech ETFs. That's just insane. And that, it's all been going on. It's all been going on,
But over the last, was it 1.5 weeks, it's been down 28%. So
yeah,
this is just making up.
Yes, I mean, we look at KWEB right now, the 40% rise it did today has pretty much made back the gains of the last 7 or 8 trading sessions. So we did fall around 23%, and today's 40% gain makes back that 23%. So a lot of the gains we've seen today we saw the NASDAQ up over 500 points, pushing back at 1400, and we've seen some huge gains in a lot of these really beaten down names. But again, it's just making up big losses, and we're pretty much where we were last week. So although it looks great on the P&L front, if you're long, it's taking you back last week. But I'd rather be at last week than where I was yesterday. So
Definitely.
So
if you're wondering why the Chinese stocks have rallied so much, it's because there's been a pledge from the Chinese central bank to keep capital markets stable and to stimulate economic growth, something that they weren't specifically targeting before, or it seemed like their stance was not as favorable to these big tech names.
That is huge, because we've seen China over the past 7 to 8 months just take a don't give a crap about what the share price is doing type attitude. The way they've been treating a lot of these big tech names, really cracking down on the big owners, they're just cracking down all over the place. We've seen, obviously, with Evergrande, the issues with them in the real estate sector and the whole housing crisis there in China due to really easy policy. And then China's realized this and then reining back, and that's had its effects. And now China actually pledging that they are willing to support stocks is huge, because it's the first time they mentioned that. And also, a lot of the fear over the past week and a half has been this report from the US that they potentially will delist. A lot of these big tech names were on the delisting list, if that's the way to say it. And we had Alibaba was on there, Tencent, or if they don't disclose new information, new organizational structure to the SEC, because China's always been behind this sort of barrier, and they never had to disclose information, regulatory information, the same way as the domestic names like the US stocks and other ones. Like Chinese stocks sort of had a pass, and that's what it all started with Trump, and now it's been followed through over here. And so we had this report, and so these stocks just got absolutely hammered. Baba actually went to a low of 74 yesterday, 73 or 74, and today it rallied to over 100 and something. And so what happens, as well as the Chinese central bank coming out saying they'll support stocks, the premier coming out saying they'll support stocks, they also said they will help these companies sort out the necessarily regulatory information, should I say, to help with their foreign listings. And that was also, so it was a double. It was basically to support, and that they will help these companies comply with the US requirements. And that really has pushed these stocks up just huge, and it's good because I mean, have you been playing much of China?
Well, I've got a decent exposure to Baba, as well as a lot of the smaller companies such as Neo and Xpeng Motors. Even though my largest position is within Tesla, I'd like to own some of these smaller EV players as well in China, because I think they're in a much better position than a lot of the legacy automakers in terms of the new transition that we're making to EVs. On another point, in terms of Baba, Charlie Munger in Jan said that he had something like 600,000 shares of Baba, and well, who knows if he sold out? But if you look at, I was just checking out Berkshire Hathaway's Class A shares, and they've now, for the first time, over $500,000 per share. It's up almost 100%.
That's the place to be. That's the place to be. Don't ever bet against the Warren. I'm telling you,
Yeah.
Yes, I mean, if you look at Berkshire today, that's the Class B. Their main shares of Class A is currently trading at 504,306. Whew. That's mad.
That's mad,
And I mean, and this year, it's one of the few stocks that's actually up this year. It's up over 10% this year, and it's more than doubled since in the last 5 years. So it has been a performer. Just like you, I was long Baba, I was long Neo, and Baidu and K-Web. I did mention at the beginning of the year that I thought K-Web was overdone. Well, we saw what happened at K-Web. But basically, Baba, I got out at 112. I was long. I got out at 112, then I got back in at 100, and then I then took a loss at 90, and then it went back to 74, and then I'm just like, what, forget that. But now it's back at 100. So I guess I had plenty of chances to buy it back. But Baidu was a tough one because I had that at around 165 for quite a long time, and at 111 I'm just like, what, I've had enough. And same with Neo. I got out at 20, and then Neo actually went to 13, and I was thinking about buying it back at like 13, 14, but then I didn't. But right now I think it's about 17, so I can still buy it back for less than I sold it. But K-Web was the big one today. I just want to quickly share this, just a quick chart of firstly, what's been happening with K-Web and the Chinese internet stocks, and where the real move has actually happened. I mean, we really started to move down substantially lower since mid-February, when we were trading at 37.50, and then from 37.50 we continued going lower and lower and lower, and then we actually hit a low of $22. And actually, those who follow the average trader portfolio, it's been a bit of a tough ride, but I actually bought some calls, the 30 calls in K-Web for $200 an option on March the 10th, which was last week. And I was really tempted to close it out today, but if you look at the 30 calls now, they're trading at 490, 505. So I put last minute of the day, I put a $5 offer in to sell it, but it didn't actually fill. So hopefully tomorrow I can get out of that. So that would be a nice 150% profit. But hopefully if it sort of goes up a little bit more, because we're slightly higher in the post market, so maybe might have to get 520 or 530, so it can help make back some of the losses in some of the portfolio. But it's been a bit tough on the old portfolio. But K-Web, that was, sometimes, like they say, you just buy in the face of danger, and that's what you sometimes got to do, when everyone else is selling, and you just look at the valuations and then you see this sort of bounces. Look at this bounce, it's just insane. I mean, so we are actually trading back on March to 4th levels. But yeah, we did get in 22, when everyone was dumping. That was peak fear right here. And that Chinese, I guess even the Chinese government couldn't ignore that. So it was pretty wild.
Definitely.
But,
yeah. So in terms of my portfolio action, just on Monday, I was thinking, things are pretty low. So, Tesla under 800 is always a buy for me. So I accumulated a whole bunch of shares at the 770 range, and also bought Google at 2,538 or something like that, and a partial share of Amazon. I also saw.
of course,
sold some.
Amazon done the 20-for-1 stock split. That's also happened as well. You know?
Exactly. But if it was this time last year and Google and Amazon did this, their stocks would just be through the roof. But
see, this is the question. So remember when we were saying, and everyone said there's no real difference, right? But last year, announcement like that, because of the peak euphoria, just a frothy market, it just pushed it through the roof. And now we're in a more normal market environment, although we're in obviously in a sell-off stage right now, but it just shows that, just splitting your shares doesn't really add any value to the company, because the thing is, everyone, like you can say, if you wanted to buy Amazon shares, you can get partial shares. So you don't even need to, it doesn't actually make a difference. But this is what it is.
So with the Fed action today, the market was largely expecting some of the Fed statements today, and I guess it was a bit of a sell the rumor, buy the news type action, but it's always weird because the Fed, or Jay Powell, in his announcements today, he was saying, they'll keep on looking at the data. They'll keep on referring back to the data. But if you look at the data they actually look at, they're always working with lagging indicators. So how can they ever get ahead of inflation? Unless
I think everyone and their dog could have knew inflation was going to run hot. Apart from the Fed, apparently the Fed knew, but they just wanted this market to keep on going because they realized how much the market loves the drugs, loves the heroin, continue injection. And the thing is, I think today, they didn't surprise really. They didn't do a 50 basis point rate hike or a 75. They just done your 25. They said they're going to continue to raise rates. They did acknowledge, obviously, the toll of the Ukraine war and the U.S. economy is remain. It's put a lot of uncertainty into the economy and potential future. In terms of outlooks for a lot of the companies and what's going forward. But the thing is that was already known. It was all baked in. So, you look at this whole Fed statement, it ended up being a bit of a nothing burger. Yeah. They obviously said they're going to start running down their balance sheet a little bit. It's so big. The question is now, the vote was 8-1. And so Bullard, who has been the most hawkish member of the Fed, he called for 50, but 8-1, so it's a good majority, 25 basis points. Now, the thing is that if Russia, the problem is all of what is going on and most of this inflation is supply side driven, not demand driven. And now with China, so let's go. China is actually most of the news, this week, because not only did we have this huge run up in Chinese stocks today, but we also having a huge COVID outbreak in China. Right. And the thing is that 51 million people are in lockdown in China. And now that's going to cause more supply issues. That's going to exacerbate the supply chain issues. And it's just going to underpin inflation for some time to come. So, I don't know what the Fed can do when China just locking everyone down. And,
obviously that's taken its toll on the oil price already if that many people are locked down. So it looks like we're down around almost 40% from the highs.
Yeah,
recent highs. Yeah,
but like I said, I think the agenda. I've mentioned it to you before. There's definitely an agenda. I'm telling you, the week before last was about $3.60 a gallon in New Jersey, and as the oil price was going up, the gas stations were going up in real time with oil prices.
Yeah,
and now they don't come down. And now we've come off 40%, and it's been off for about a week. From the high, and we're still above 4.
Of course,
still above 4. And so this is the thing: is this? Obviously, I could appreciate that these guys just want to milk it as much as they can, but it's just the time we live in.
I know, but I guess it's always been like that. It's quick going on the way up, and then it takes its time going down. And they always say, "Oh, well, we bought our inventory, we bought our fuel at these higher prices," but not all of them do.
Uber
and Lyft,
55-cent surcharge.
Fuel
Delta out in a $15 surcharge. Now the question is, if we get all back to 60-70, are they going to remove them surcharges? Nope. No. They just reacted. Exactly. They just saw the opportunity. For 1 week, we saw this big spike in oil price, and what happened? All of these companies added on the surcharges for that 1 1 week action. They didn't see if it's sustained. No, they didn't want to see if it's sustained. Let's just see if it's sustained for a couple of weeks. No, it's gone up. Right, let's add it on straight away. Boom, 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 and it's going to be a year before they take it off. And this is just the world we live in. And you know the way they can do it. They can always just say, "Oh, look, it's the fuel cost. It's it's to the driver. It's just all garbage." But this is just what's going on.
Yeah, exactly. Do you think that there's still a bear market ahead, or are we going to continue a market rally?
The most classical signs of a bear market is when you just get huge rallies like this, like huge dead cat bounces. And a lot of this is a lot of short covering. This Chinese move, a lot of it's got to be short covering, plus obviously people initiating positions. The way we bounced these last 2 weeks, again, it's very reminiscent that we're still in a downtrend, but sometimes you just got to let the charts do the talking. So actually, we've got the chart that have been, and the lines haven't changed since the last time I done the analysis on it. So let's just have a look. And so we've got it here. And so we talked here that we had this pin bar, which was very similar to this one over here. And then we had this big move up, had the same thing. Do you actually notice on this first pin bar over here, we sort of went up, try to test it, but we didn't take it out. Then we rallied, came all the way here. We rallied, tried to take out this low, but we didn't. So here we had a lower low and then another lower low, but then we didn't break this low over here, which was the Feb 24th low. We actually double bottomed here. So we had 2 attempts to get below that level, but we didn't do it. So now we've had 2 massive green bars going back towards the top end of this channel. Now, if we take out this trend line, which is over here, and break above this level that we got to the high of the previous move, then I could say that we maybe snap the downtrend at least short term, and we could sort of push higher. So I think now this next 2 days will be really telling, because given the volatility that we've had in the last couple of days, it's very likely that we're going to breach it, or I can't imagine us staying here. So either we're going to go back down, back to this region, the low 41.35. This is already in the S&P, or we're going to push back up. And if we take out 4,400, we can go back towards 45.50. So just looking at it on a technical point of view, we have really held this this lower low over here. We did not break it, so that is bullish. We've had 2 huge bars. So I wouldn't be surprised to see some consolidation like we did over here. Like you see these bars, a whole bunch of large bars just back and forth before it decides, so I wouldn't be surprised if we get a whole bunch of bars going like here sideways. But again, you can use this as a guide, an indicator, but I'm really looking to see if we take out this level over here, and if we can end up the week and settle above 4,400, then I think short term we've definitely formed the bottom and we can continue going higher a bit. So that's what I'd say in the fundamentals. In terms of the technicals, obviously, if we can avoid World War III, that will help.
We have to look at what the main fear drivers are currently. With the Fed, they were saying GDP is 2.8% target of 22. And I think everyone got a bit freaked out by that. But then Jerome Powell gave a decent explanation, and he said it's still very strong because previously, they were looking at something along the lines of 2.1%. And I think now the market is priced in 0.25% hikes in the 22. So
remember when I was saying at the beginning of the year 4, and you were like, I don't think so. Now we've gone to 7. I'll be short 7. I don't think they'll do 7. I'm short in 7. Taking that. I'm taking the under on 7.
So where does that bring us to, like 1.75% to 2% if we get 7? And like you were saying, the war fears, at the moment it seems like they could potentially come to some kind of compromise and some kind of peace deal, maybe by the end of the month, maybe. And
Putin, the way I see it is he's going to try to save face. He's going to still act like the macho man, but it's hurting the economy. Virtually everyone's jettisoning the country, and it's how much can they really take? The real question is, let's just say they come to some type of agreement. What's going to happen? We've seen, how are these firms all going to go back into Russia, or are they going to trickle back in? What's going to happen to the sanctions? Are they going to slowly get lifted, or are they going to lift some of them? What will be the reward, or what will be the incentive to stop this for Putin? Because now he's just thrown it all in. I guess, maybe energy. The thing is, I think long term now, a lot of these countries are going to be working towards energy independence, especially, but at least short term, there won't be the same type of resistance towards buying Russian oil or, Russian wheat. I mean, other commodities.
Yeah, definitely. I mean, it's difficult to say, what everyone's going to do, but if there is like legitimately a peace deal, created, there's no need for the Russian people to suffer any more than they currently are, and to start back up the economy as soon as possible, because regardless of what one man's actions are, we do live in a global economy now, and I think the longer that these sanctions stay on, the trickle effects are uncalculatable at the moment, but they're definitely going to cause negative side effects for the whole world. So yeah, let's just hope, fingers crossed, we can get to some kind of peace, and it looks like, at least in the short term, that would also rally markets, because like Jerome Powell was saying, like, he doesn't believe that there's a wage price spiral, or also, like, he doesn't think that there's
Did you not see Starbucks? Did you not see
Yeah.
Starbucks announcement? Starbucks are now going to be paying their employees like $23 an hour.
Yeah, it's crazy, but
No
what I'm
inflation.
saying is
$8 a coffee. That's what it's going to cost.
this is the difference. I mean, he's just looking at lagging indicators as well. So, as an average trader, you can't just trust everything that you're given. You have to do the research to see, like, what's really behind it. And the market is smart, it's pricing in. It's very fearful, and it acts sometimes like a crazy teenager, especially in markets like this, with getting fearful for, it seems like very trivial reasons. But all it's trying to do is price in the future. And I think it's had enough time now to do that, and the market can now calm down.
Combination with that, and also just generally real battered down valuation in a lot of these names.
Yeah,
like the big caps have held up relatively well, like your Googles, Teslas, Apples, Microsoft. But I mean, the real opportunity in my mind is not in those stocks, because it's in these other ones that have just been taken to the cleaners. And we actually had Moneyline that did report. I've always talked to you about Moneyline trading at $2.11 or 30 or whatever it is, and they actually they're forecasting that they're going to be break even by the end of the year, yet they're trading at $2. It's insane. And we've got just a lot of these names that have been absolutely cream crackered, and I just feel like you will naturally just get a bit of a bounce. But the question is, with all of these stocks, I'm just looking for this sort of, I'm not long term on it. If we keep on getting a move like this, judging by where my portfolio was and then where it is, and then if we get another 5%, 6%, if we get another couple of moves like this, I'll be like trimming 15% of the portfolio. Definitely. It might go up, but I'm not looking at the numbers we were at in November, because that was froth.
Yeah.
Extra jubilant markets trading on craziness, right? So the thing is, I'm being realistic, and so if we do, break that trend line, I was saying I'll definitely be just like trimming a bit off, and I did that the other day, and I did it a couple of days early, but then I did actually initiate position in Jets, which is the airline ETF. I recently went to Seattle. And then my wife went to LA, and the travel scene is just mad. And then we had an airline conference earlier, I think on Monday, was it Tuesday? We had United Airlines, American Airlines, Delta, JetBlue, all of them come out, and they're all reporting, like they all raised their revenue outlook, seeing really strong demand. They're seeing return to strong business demand as well. There's obviously a bit of uncertainty going on with Russia, but domestic travel hasn't really been affected. and you can just see that it's really, really picking up. Loads of people are traveling. These companies are starting to make decent money and really get back, if not surpass 2019 levels. So, looking at all of that, I just initiated a position in Jets because I didn't know which one to pick. I just chose the ETF, and so hopefully, even with that, I'm not a long-term holder, but like I bought it at 18. I think it's like 19 or 20 right now or something. And hopefully if it gets to like 21, 22, I'll just get out and that'll be done. Because I think right now the best way to play it is just trade this market. We're getting such massive candles up and down, and I might be wrong, but this market ain't just going straight up, straight down. So it actually pays to take profits and then re-enter and, just improving your basis and, And
it seems like in this market, if you have some capital put aside and you want to get in, the best bang for your buck is some of these heavily beaten down names. Which ones do you reckon are good plays at the moment?
Yeah, so, I mean, I've my largest, well, I guess our largest holding is Amazon, and the thing is, Amazon went back above 3,000. So I mean, despite all of this, it's still above 3,000. Just like you, I've been accumulating Google because I actually think Google out the bunch is the best one in terms of just how explosive their revenue growth is. I've been,
it's literally a cash cow. You can't go wrong.
So when Google announced the 15 for 1, or was it 20 for 1 stock split, and it was at 3,000, because I never actually had a position in Google before that, and then since 3,000 I've just been averaging all the way down to now 2,500. So I think my average is now like 2,650 or something like that in Google. But I haven't I want to get into Apple, but Apple just has not retraced enough for me. Like it was at 180 and it gone to 160, and then it almost got below 150, and then I'm like, do I really? And then it's back at like probably high, like 158 or something. But I'm just waiting for, I mean, my Apple exposure is through my exposure of the long S&P 500. So S&P 500 is got, I think Apple is what, like 6, 7, 8. I don't know what the percentage is, but it's a decent percentage in it. So, but the thing is that having, and I don't have any Microsoft as well, to be honest, and that's been hit a bit. But right now, Amazon and Google and obviously Tesla, but I wouldn't classify Tesla in the same category as those yet, because Tesla still although the potential is to be one of them, it ain't one of them yet. So
but I think we talked about it in one of the previous podcasts. The reason that Apple gets such a high valuation is obviously it's a absolute revenue beast. But in terms of return on invested capital, Apple is by far the highest in the whole market at the scales that they're talking about in terms of the billions, around 40%. But why I've got so much conviction in Tesla is, they're slowly creeping up to be second place, getting up to almost 30%. And as they keep growing their revenues, and they've got such pricing power at the moment in an industry that everyone is moving towards. Obviously, it's not great when they raise their prices for consumers, but having wait lists of 6 months or so, or even longer, just means that they can pull levers that others also should follow suit, especially the legacy automakers, just raise their prices. They can't make enough anyway. They should just, try to eke out as much profit as they can, because they're currently interesting to see, likely losing money on those.
It's interesting to see how the different players play, because, with Apple, they might, obviously they charge a lot for what they do, but, if they got $1,000 phone to 1,100, people still afford it. But I think now Tesla, with their Model Y going into the 70 grand range, I mean, I don't know what the target market and how big that TAM is for that price range of a vehicle. So I think what they're doing is, knowing what it is, they're just like, right, we're going to jack it up, and they've got enough demand, and whoever bites the bullet at that price takes it. But, I can imagine the rate of reservations will probably be going down quite a bit, but they don't need the reservations, because Tesla, it's interesting because I have an order for a Mach-E, and now Ford have stopped. You can't order a Mach-E. You can only order the base model or the GT model. And so the California Route 1 and the Premium, you can't order it. So that is the way Ford went about it. And Tesla's like, well, you can order it, but you're just going to pay a lot more. And so, like, if Ford could have done that, they could have just said, right, you could have bought the premium if you want, pay 65, right? But they just said you can't order it because they can't produce it, right?
They just can't produce it.
Whereas Tesla, I think they just say, all right, you guys got to wait, but pay 70 grand and wait. And so it's so it's funny. I mean, just different ways of doing it, I guess.
The thing is that for Tesla, it's prudent to raise the prices because it's all down to supply demand economics on these products, and the more demand there is for them, if they're still selling it at their original price, even though their raw materials costs have actually gone up, the resellers are going to be the ones buying it off Tesla and then reselling it on the open market for more. So why let the resellers get that delta in price when the company can actually keep that for themselves? Because no matter what, I mean, obviously Tesla doesn't have the Mercedes-Benz type, quality inside or anything like that. But in terms of a value proposition with a car that has all the hardware and is a leader in full self-driving, even though it's not there yet, but just having the potential to do that means that their cars can command a premium. And you have to always look at residual values as well. A car that's going to be full self-driving capable, in 5 years' time, is still going to have an amazing residual value compared to
this is my argument with that, because there's people that bought the full self-driving package in 2017 and 2018, and now they can't use it, and their car is they have to get an upgrade on the car, so they've just lost 10 grand basically.
Yeah, well, that's the thing. It's so you're early to buy at that time. They're the ones. Thankfully, they're the ones funding Tesla to get to the state they are. But if you look at the FSD 10.11 beta that just came out, just watch some of the YouTube videos on there. They're getting close, they're getting better and better, and they are just so far ahead of the pack, you can see, in terms of real world full self-driving in all conditions. It's not going to be ready, I don't think, this year, but they're getting close, very, very close. So, I would say maybe in the next 2 to 3 years time, I think we're going to be, in a position where all of the Tesla vehicles, they have or they don't have the full self-driving package themselves, the cars themselves, knowing that they have the ability to full self-drive, they're going to have some kind of floor in the price. So if you are someone who's going to be, paying $60K for a Model Y at the moment, I don't think you should feel bad and think that, the price is going to go down anytime soon. Like, every automaker is just clamoring for these raw materials to get batteries. It's not like, things are going to come down soon. Like the movement has started. Obviously, these high oil prices is not good for the economy at all. But it just means that more and more people are looking into EVs, and for anyone who's producing them, you just won't be able to have enough supply to meet demand for at least the 3 years. I would say 3 to 4 years. Because it's not like they can just produce more of these raw materials. To set up a mine, sometimes takes a decade, right? So it's a very long process, long drawn out process. And just to let you know that if you see any articles saying, there's a sodium battery that's going to revolutionize the battery industry or anything like that, or you see these articles, solid state, the thing is, they're all in a lab and they all have to be tested. And when they have to be tested, I mean, needs to be not just tested in a car going around the track. It needs to be cold weather, hot weather, how the batteries degrade over time. You can maybe simulate that through on a computer, but the real world tests on those, they take a long time. And you don't want to be, selling a car to someone and then the batteries start dying within a few years' time. If you're in, like a really cold place in Canada or something like that, and your battery is having to cycle through these hot and cold temperatures at the extremes, you're going to have a real bad brand image if your cars are failing left, right, and center. So if you see anything like that, you need to know that when you see it in the newspaper, that tech is still minimum 5 to 8 years away. So what we're looking at for the foreseeable future is lithium ion and LFP batteries. That is what the industry is really focused on at the moment. But again, it's all down to who can supply as many as possible. So that's why my bets are all on Tesla at the moment. After all the PR that you see from Volkswagen, Ford, GM, all those guys, they just give the talk. They're saying we're investing X billion, 15 billion, GM, and you just see year
there's
after
so
year.
many nice looking cars that, I'm seeing every time. We just had Volkswagen. Was it Ford and Volkswagen now collaborating on a MEB platform, and this new car, and I'm just like, just show me the damn car. Let me buy the damn car, and then we talk. Because you know what, the thing is, I know it's an issue all around, but gosh, it's
and it's not like they can just solve it like this. It's not like the supply chain for all of these legacy automakers. It's just not there currently. So for EVs, that's why they're having such a hard time. And for anyone who thinks it's just as easy as dropping batteries into a regular car, if it was that easy, everyone would be doing it. But like there was this Forbes article where this guy John Markman, he was saying, like, despite countless press releases and bravado, GM is not really in the EV business at this stage. GM's more focused on giving the impression that it's an EV leader, more concerned with placating investors than making products that customers love. And that's exactly right, because it has made this many EVs this quarter, and last quarter they made 26. So, and this is who Joe Biden is saying is the leader of the EV market. So I'm just saying, like, the perception and what you read in the marketing, I guess it is marketing stories that you read in the papers and on the news. It's just not. It's far from what reality is, and you need to know. Like, at the moment, I'm just telling you, it's only Tesla who are going to, can actually produce anything in meaningful volume, and the Chinese automakers are like second place. So there's this Imperium Skyline. It's like a $35,000, decent sized SUV. And I think, like, that more and more of those will start coming to the US and Europe.
Yeah, I think if China can come in with those, and rather than having 60, 70,000 for an EV, and you can buy it for 35, 40, that will be the biggest game changer in terms of adoption.
That's it.
Yeah.
That's exactly what it is. And I think, you might have an impression that the Chinese EVs aren't quality, but, I'll just ask you to look at the fully charged YouTube channel. Just check out some of the EVs that are coming out from China. They can make cars. They can make cars. And this is just going to be another, like in the 70s when, there was the oil crisis, and, the American automakers didn't respond too well in terms of fuel efficient vehicles, and the Japanese took over. And they didn't even, if you watch I think it's Steve Jobs, you're saying, like, the Japanese don't talk about quality, but they do. Like, they don't need to say it in their marketing materials. They don't need to say quality back then, but they used to just make quality vehicles that used to last, and it used to cost a small amount to run compared to the American vehicles. But now it seems like, with the EV, you can't really go wrong. Rajan, I really hope you do get your Mach-E as soon as possible, but I am not optimistic that it's going to arrive anytime soon.
I got the emails, so that's about it. So we'll see.
Okay, so now what are average traders supposed to do in this market?
Well, you just got to keep on doing what you've been doing. Nibble on the downside, that's what I've been doing. I'm running dry of funds pretty much. Everything that I did have, I've just been nibbling. And now, what my real plan is, if we continue to rally, start just taking bits off the table. Like, keep the core positions on, but just trim around the edges to free up space. And that if we do get a downturn, and just, like I said, just keep on chopping, just playing the chop. And the thing is, if it does keep on going up, you still got your main, you're still long. But I think it's prudent to trim as we go up, because let's not kid ourselves. Despite this big rally in the last 2 days, nothing's really changed. So
recession risks are still very high.
There. Fed is still going to raise rates. The war is still happening in Russia. Supply chain issues are still there. Inflation is still well and truly here. So nothing's really changed. It's just that we are bouncing from an oversold condition. And if you looked at the technicals that I just mentioned earlier, you saw just the bounce based on these oversold conditions. Now we've gone back up towards that last pivot high, and so we'll see what goes on. But now we get towards that region. So it'll be, I'm hoping on Monday, not Monday. What day is it? Wednesday. Yeah, so on Thursday, we get a bit of a continuation. I'm going to try to definitely get on my K-Web position, and just take it from there.
Yeah, definitely. I think I'm going to be mirroring your actions, hopefully to try to get out of some of these lost leaders. Scratch out of them.
If I was down 60%, and if I can get down 25, I'll just do it. Yeah,
exactly.
So that's it. But anyway, hope you enjoyed the content today. Please like and subscribe if you like what you saw, and please feel free to leave a comment if you've got any questions, or if you would like us to talk about anything. And and we'll catch you on the next one.
Yep. See you guys in the next one.